Ladies and gentlemen, good day and welcome to Q4 FY23 results conference call of Kalpataru Power Transmission Limited, hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhineet Anand from Emkay Global Financial Services. Thank you, and over to you, Mr. Anand.
Thanks, Nirav. Good morning, everyone. I am Abhineet Anand from Emkay Global Financial Services. First of all, I'd like to thank the management for giving us this opportunity to host the call. I will hand over the call to Mr. Vishesh Pachnanda, VP and Head Investor Relations. Over to you, Vishesh.
Thanks, Abhineet. Thank you for hosting the call today for us. A very good morning to all the participants. This is Vishesh Pachnanda. I'm pleased to welcome you to Kalpataru Power Transmission Limited earnings call for the fourth quarter and the full year ended 31st March 2023. We have with us today the management team represented by Mr. Manish Mohnot, the Managing Director and CEO, Mr. S. K. Tripathi, Deputy Managing Director, Mr. Amit Sukleshwar, Director Group Strategy, and Mr. Ram Patodia, CFO and President Finance. We'll start with a few minutes of opening remarks by Mr. Manish, and then we can open the floor for Q&A. With that, and without any further delay, over to you, Manish, sir. Thank you very much.
Thank you, Vishesh. Good morning, everyone. Thank you for joining us on the call today. As always, it is a pleasure to interact with all of you. Let me begin with our full year performance in detail, highlighting progress on our strategic priorities and then outlook for the financial year 24. Before I start, let me put forth that with the completion of the merger and the appointed date being 1st April 2022, our standalone results represent the combined standalone financials of erstwhile JMC and KPTL. The performance for FY23 has been remarkable for the combined entity as we continue to accelerate profitable growth and build on our position as a leading player in the global EPC market. We have recorded noteworthy performance on many fronts, which includes robust top-line growth, remarkable and strategic order wins, stable profitability, and notable management of working capital and debt levels. Our strong diversified order book and favorable business outlook across all our verticals provides us with a huge runway to growth in the next couple of years. Having said that, we will continue to focus on accelerating growth while improving profitability and upholding the strength of a strong balance sheet. The financial year 2023 has been a landmark year for KPTL as we have completed the merger of JMC with KPTL. The merger reinforces our market position in high-growth EPC business verticals and places us favorably to leverage on the global push for infrastructure development and fast-paced adoption of clean and green energy. During the last few months, the benefits of the merger have already started to kick in some form or other. We have improved our ticket size of order wins, particularly in the civil business, as we have secured numerous high-value orders in water, B&F, and urban infra business. We continue to gain traction in expanding our civil business in both domestic and international markets as we have added new clients and improved our global reach. Additionally, on the finance cost front, we are already working with our lenders to provide parity in terms of finance costs between erstwhile JMC and KPTL. We are already seeing positive momentum on that front. We have also internally realigned our operating structure to improve efficiency and reduce costs. The benefits of all these actions will increasingly improve our performance in the coming quarters. Coming now on the performance front, our consolidated revenue grew by 11% to reach rupees 16,361 crores, and standalone business grew by 16% YOY for the full year 23 on the back of robust execution. Our consolidated EBITDA margin is at 9.1% and the standalone EBITDA margin at 8.9% for financial year 23. This EBITDA margin includes an amount of 109 crores shown as exceptional item in published results, with respect of an award obtained by an erstwhile power transmission subsidiary and is contractually receivable by the company. With improved execution of profitable projects, productivity improvement initiatives, and merger-related benefits, we expect margin performance to improve going forward. In FY23, we have put considerable efforts on project closure and timely collection along with adopting a prudent approach to capital management which has helped us to maintain our finance costs despite the ongoing environment of increasing interest rates. Our finance cost as a percentage of sales has remained at around 2% at the standalone level, which is nearly similar to the year financial year 22. We are confident to maintain finance cost as a percentage of sales around 2% for FY24 also. Our net debt at the standalone level has declined by 373 crores QOQ to rupees 1680 crores at the end of March 23. While the net debt excluding non-core business stands at rupees 1800 crores at the end of March 23. Our net working capital days are below 100 days at the end of March 23 for the combined entity. During FY23, we have invested close to rupees 500 crores for capex for improving project delivery and achieving our growth targets in FY24 and 25. We expect capex in the range of 250 to 275 crores in FY24. Our standalone PBT after exceptional items grew by 48% YOY to rupees 738 crores for FY23 with a margin of 5.1%. Similarly, PAT rose by 52% YOY to rupees 531 crores for standalone business. At the Concall level, the reported PAT was rupees 435 crores for financial year 23. Our order book, including LMG Sweden and Fasttel Brazil, was at rupees 45,918 crores as on March 23. Additionally, we have an L1 position of around 4,000 crores. In FY23, our order inflows grew by 39% YOY to rupees 25,241 crores. Our growth in order inflows was led by T&D, B&F and water business. In FY24 till date, we have received orders of rupees 4,114 crores. This is including orders of rupees 1,229 crores declared in a press release yesterday. We are targeting order inflows of over rupees 26,000 crores in FY24. Coming now to individual business verticals. In the T&D business, we have secured orders worth rupees 10,000 crores in FY23. The T&D business order book, including our international subsidiary, is at a record high of around 16,500 crores. Additionally, we have an L1 position of over 2,500 crores in the T&D business. During the year, we strengthened our position in existing and new geographies by securing various high-value projects. We are also selected as a preferred EPC partner by a major utility in Australia for executing a large-size EPC project for renewable integration. This is a significant achievement for us and demonstrates our capability to manage and execute such large-size complex projects at the global level. The business outlook remains very promising on the back of the push for renewables and setup of new T&D infrastructure in India and international markets. We have a huge tender pipeline of over 50,000 crores in the next 20 to 24 months for the T&D business. In the international market, we have robust visibility with tender pipeline over $4 billion, especially in focus markets in Africa, Latin America, Asia, and Middle East. In Fasttel Brazil, we are focused on project closure and strengthening our organization in FY23. Fasttel reported a full year revenue of 439 crores with an order book of rupees 1140 crores. Similarly, at LMG Sweden, we have achieved revenue of rupees 1,002 crores with an order book of 1,009 crores for 23. In our B&F business, we have achieved growth of 25% YOY to rupees 4,136 crores in FY23 on the back of robust execution and a healthy order book. We continue to improve our market standing by securing new clients and improving our presence in areas like data centers, institutional buildings, processing plants. Additionally, this year we have secured our second B&F project in the international market in line with our strategy to expand our civil business to newer markets outside India. Our water business continues to be on a solid growth trajectory as revenue grew 54% YOY to reach rupees 2,622 crores in FY23. We have secured orders worth rupees 7,553 crores and have an order book of 12,476 crores in FY23. We are consistently investing in strengthening our capabilities in order to improve our competitive position to execute large-size projects in the water business. In the railway business, revenue grew by 4% to reach 1,652 crores. We continue to adopt a prudent approach and remain selective in bidding given the higher competitive intensity. During FY23, we have secured orders of rupees 1,557 crores and the addition of two large-size metro electrification projects. We are increasingly looking to strengthen our business in areas like metro electrification, SNT, RRTS, and high-speed rail. In the oil and gas business, reported revenues of 985 crores for financial year 23. Our business visibility in this business remains very good in India and international markets. We have received qualification to bid in 6-7 countries in the oil and gas business, and we expect to expand our international reach in the near future. Our urban business grew by 23% YOY to 403 crores on the back of execution of a new project secured during 23. We are improving our capabilities to secure projects in metro rail, elevated roads, public spaces, airports, etc. Our road boot SPVs continue to witness good growth backed by improvement in traffic. Our quarterly revenue increased by 21% YOY to rupees 58 lakhs in Q4 23. We have infused an additional amount of around 71 crores in FY23, largely to fund the repayment of loans. We have appointed advisors to evaluate the sale of road boot assets, and we are receiving active interest from large foreign investors. In Shishugam Logistics, we achieved revenue of 109 crores with EBITDA of 22.5 crores. The business remains under pressure given lower utilization of warehouses because of decline in procurement by government agencies. During FY23, we have collected around 70 crores from the sale of Indore real estate. We aim to complete the sale of the balance inventory by calendar year 24. The board is mindful of the importance of returns to shareholders, and as a result of the strong performance and ongoing confidence in the strategy, it is pleased to recommend a dividend of rupees 7 per share. Now moving to the outlook of financial 24, I want to mention here that our business today has never been so strong in terms of size, scale, capabilities, diversified business mix, and financial profile. In this context, we will continue to manage our business with agility and focus on consistent and profitable growth and reach to pre-COVID level of profitability from a mid-term perspective. Additionally, our focus remains on the speedy resolution of non-core assets. We expect standalone revenue growth in excess of 30% for financial 24 and PBT margin in the range of 4.5% to 5%. We expect finance cost as a percentage of sales to be in the range of 2%. We are targeting to achieve ROCE in the range of 18 to 20% for FY24. Our tender activity across all our business remains favorable and provides a huge runway for growth. We expect order inflows, including our Sweden and Brazil subsidiaries, to be at around 26,000 crores for financial 24. However, we remain watchful for various uncertainties related to geopolitics, inflation, commodity and currency volatility, and are accordingly navigating them through strengthening our risk management and building a diversified business and improving our execution capabilities. With this, I would request the moderator to open the lines for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good morning, sir. My first question is on the synergy benefits. If you could help us understand what kind of operating level benefits are we expecting, and by when should we start accruing the benefits to the full? Aligned with this, what are the timelines and progress in terms of divestment of the road boot assets and other non-core assets for the portfolio overall now? That's the first question.
Good morning, Renu.
Morning.
Renu, our merger benefits, if I had to put it in 3 buckets, one being the interest cost advantage, second being advantage on productivity, and third being the advantage of getting large size projects, all of them have started in some form. On the interest cost, the difference between KPTL and GMC in terms of the rates was closer to 200 basis points. Majority of the bankers have now agreed to get the erstwhile GMC limits to the KPTL cost of interest. And a lot of them would happen starting from Q1 itself. Some have happened in Q4, but the filing for the new rates and the new limits. So we expect a lot of it to happen from Q1. So on that grounds, we expect, as a merged entity, at least 60 to 70 crores coming in as gains getting into the next year itself. On the productivity levels, a lot of our back-ended functions, primarily finance, HR, IT, project management, PMG group, QA, risk management, all of them have been merged. wherein we have looked at keeping the best resources there and the balance have been deployed to various projects or have looked at opportunities outside. We've not seen a lot of people leaving us, but they've gone into different roles within the group, given the kind of growth which is happening, and those benefits have also started coming in. On the IT front, now we have a unified SAP wherein the entire organization is running, and that also brings in cost savings on every aspect, whether it is AMC, whether it is licenses or anything and everything. The largest benefits comes from our ability to bid for large-scale projects with integrated capabilities of civil, mechanical, electrical. And you've seen the success in airports, the success in urban metro, the success in international projects, including civil projects, our ability to bid for large projects, and the entire ability to bid for higher value projects and not smaller value projects is helping us. So if you ask me, all of that has started. On a quantifiable business basis, we have said that we should be seeing 100 crore plus benefit coming in over a period of time because of the merger. And I'm pretty confident that you'll see that coming in from 23-24 itself. So that's the first one. On the second one, on the road boot assets, we have appointed advisors and we expect to sign a non-binding offer for at least one out of the three assets in the current quarter itself. We are seeing good interest from a few large players, from 4 or 5 large players. And we're pretty confident. I know we have said this in the past also a few times, but this time we see huge traction. We're pretty confident of signing at least one non-binding offer for the largest road boot asset in the current quarter itself.
Got it. Right. Then coming to the core business, T&D obviously have seen quite strength in terms of order flow trajectory and tailwinds. How are we looking at this business momentum to sustain growth both from domestic as well as international business? And also aligned with this, what would be the status on the low margin fixed price projects which are being completed? So by when are these projects expected to be completed, and by when do we expect the margins in the core T&D business reverting back to double-digit levels?
I think let me first speak about growth. All our business segments, except maybe railway, are targeting a high double-digit growth for the next year. Whether it is TL business, whether it is B&F, whether it is water, whether it is urban infra, or whether it is oil and gas. And that visibility on order book is available today. As far as historical projects are concerned, we are out of majority of them, if not all. Even in the current quarter, we have additionally provided for a CPC loss of 87 crores. Historical project, which has impacted our profitability slightly. And with that, I believe that we are out of all our historical pre-COVID projects in terms of fixed price, in terms of the volatility issue, in terms of freight, all of them. Significantly, maybe a few crores here and there. As far as margins going back to double digit, I think it's important to look at the size and scale, and we are looking at definitely margins improving, but double digit might still take a few more years for us to reach there. But at a PBT level, we're confident of delivering a 4.5 to 5% margin, which with the 30% growth results in a huge improvement in EPS as well as PAT for the larger organization.
Right. Kindly bear with my ignorance here. If I look at the operating level prior to this demerger, JMC was almost at double-digit levels, 10% level margins. KPTL standalone had issues because of T&D margins being suboptimal and pressures from oil and gas railway segment. So is it now that the overall at the Concall level, your comments on double-digit margins being still away for a couple of years, implying that the core KPTL portfolio, which was there in T&D, oil and gas, railways, witnesses more headwinds, while the civil-oriented portfolio of JMC continues to fare well in terms of low teens operating margins?
Renu, let me again clarify this properly. Right? JMC businesses, a few businesses were showing low teen margins, but not consistently for the last 3-4 years. At the size and scale they were showing low teen margin. Now with the growth of 30-40%, we are investing a lot in building the teams and making sure that delivery across all the projects happen. So on JMC and a few businesses will still continue to be in teams, right? B&F business will definitely be. Water might not be there. Water would be high single digit, but the B&F business will continue to be there. As far as T&D business is concerned, that is also into, high single digit. So T&D and water would be high single digit. We continue to have pressure in the railway business and the oil and gas business in terms of profitability. And that is where our margins on an average basis get to those levels which are single digit and not at double digit. Railway and oil and gas.
Got it. Thanks much, sir, for this. All the best. I'll get back with more questions later in the queue. Thank you and all the best. Yeah.
Thank you. Next question is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Hi, good morning, sir. So, can you please give us some more color on the international T&D order book and how much is the international T&D order book as of current order book, and how do you see, in FY24 the order outlook?
Sure. Mohit, on the international business, on the transmission side, our order book visibility as of 31st March, orders in hand is in excess of 11,000 crores. Besides that, we are L1 in orders of around 2,500 crores as we speak about. So in totality, the visibility today is around 13,500 plus crores as far as the PLI business goes, which includes Linje Montage and Fasttel. So if I remove Linje Montage and Fasttel, which is approximately 1,800 crores, the India international TL business, I repeat TL, not necessarily the international overall portfolio, is around 11,800 crores. As far as growth in this segment is concerned, as I said earlier, we are expecting a good 25% plus for this business on the India TLI front. As far as Brazil and Sweden are concerned, we do not see them growing at a very fast speed. Brazil would do well, but Sweden would not be growing at beyond 5 to 10% for the current year.
Understood, sir. Secondly, sir, of course, you guided for a 4.5-5% margin. What are the key risks to these PBT margin guidance for FY24? And a related question is that what is our fixed price contract in our current order book?
Sorry, Anis, what is that?
What are the key risks to the margin guidance?
Okay, let me first answer this. Today where we are, all our businesses have a visible order book. There's literally very minimal amount of book and bill which have been considered in the targets of 30% plus growth. So on the revenue front, we don't see any challenges unless there are any geopolitical issues which are completely beyond us. The existing geopolitical issues on places like Afghanistan, Myanmar and a few other countries have already been removed from the order book. So the order book has been adjusted to that extent of those projects which includes Afghanistan, Myanmar, Ukraine, and that's not a part of our order book. So from a revenue perspective, we see minimal challenges in achieving the 30% growth on an annualized basis. On a margin perspective, a lot of our historical projects are already completed and we have delivered on it. And today with low volatility in all segments of whether it is commodities, whether it is FX, whether it is freight, and with a consistent team which stays with us, we don't see much challenges on achieving the 4.5 to 5% of PBT. So as we stand today, I don't think that should be a challenge in any form unless there are geopolitical issues at India as well as global levels which are beyond our, beyond our vision as of today.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from the line of Chiranjit Singh from DSC Mutual Fund. Please go ahead.
Hello, sir. Am I audible?
Morning, Chiranjit. Yeah, very good.
Good morning. Good morning. So thanks for the opportunity. So my first question is, sir, if you look at the order backlog now, water as a segment has become large for us at around 12,000 crores. So if you can touch upon the nature of these projects and, how is the competitive intensity and do you see, this becoming larger? And similar, if you can touch upon the buildings and factories, as a segment, how is the scale up there? And you have touched upon, some of the new areas like data centers and PLI related capex and all those things happening. So in terms of the, competitive intensity, margin profile in these two segments, if you can touch upon that. That's my first question.
Yeah. So hi Chiranjit, this is Tripathi from here. As far as the water business is concerned, you are right, it is currently have a higher order book. And we see next to 2-3 years a good growth in this business. At the same time, we are these projects are spread over 12-13 states. So going forward, from here onward, we will be balancing the act in terms of the spreading the business size, because the delivery also is gathering the requirement going forward, these projects to be delivered properly, right? So yes, and we see this sector right from the water supply to the urban and the rural areas. It has taken a big traction due to the government agenda, as well as there is a lot of activities happening in the micro irrigation. Those projects are also part of the water division. So overall, we can see next 2 to 3 years there will be good run on the water side. Coming to the B&F, I think this is a stable business in the current environment when the whole sentiment and the real estate sector has revived. We will continue to see this momentum to go on, and based on that, we have also trying to diversify into some more sectors of B&F. Like airport, we already diversified, and the data center is the next thing we are looking. As far as the margin profile of B&F is concerned, our core business of core shell and the civil buildings, there the margins, because of the price rise of the commodities in general, margins will be under pressure. We are not going to see a huge uptick in the B&F margin. But the new sectors will have a better margin profile because due to the lesser competition in those sectors, particularly the data center and the airport. But those businesses are yet to be built, right? So we have just laid the foundation of airport, and based on that, we will be going ahead.
Got it, sir. So the other question is, right now the mix in terms of our domestic and international is 60-40, and we are, very positive in terms of getting into railways in the international markets. And so you see this mix in terms of domestic and international changing with, larger now, projects available in the international markets. How do you see overall international markets, and which particular segments you would like to target more in the international markets?
So, Charanjit, on the international front, we have good visible growth coming out of 3 primary segments. The first being transmission, which is a core strength. Second, civil in terms of, buildings and factories and airports and water in a few select geographies where we've been there for a long time. And third is oil and gas, where we have now qualified, as a contractor in 6 large Middle East countries, and that's giving us an opportunity to bid for that. So if you ask me from an order book perspective, you'll see all 3 coming into the next year. As far as railways and a few other divisions are concerned, we've started that process, but will it convert to a huge order book in the current year? Might not happen. But at least the pre-qualifications will be done, the teams will be built, maybe one order here and there would happen, and the largest chunk of the order book on the international front for some of this business would happen in 24-25.
Okay, got it, sir. So those are the 2 questions from my side. Thanks a lot for your time. Thank you.
Thank you. Next question is from the line of Parikshit Kandapal from HDFC Securities. Please go ahead.
Yeah, sir. Hi. Manishji, congratulations on a good quarter.
Hello.
Yeah.
Good morning.
So my first question is, sorry I missed the early part of the call. Why was the margins in this quarter lower than quarter on quarter? The margin has declined a bit of margin. Any specific reason, any legacy project? Because I think you still had some GIB issue related project in your order book. So why was the margins lower in this quarter?
So Parikshit, no specific reasons as such, mix of order book, but a couple of things which have definitely caught us by surprise, if I would use the right word. One was the FX movements in the last 6 to 9 months, by which the current year we've seen some loss because it's a timing issue because we are primarily hedged on a slightly lower rate. You've seen in the last 1 year, FX has gone up from 76 rupees to 82 rupees. So there was some small impact. So last year for Q4 there was a 7 crore gain. This year currently is a 25 crore loss. So that was one key reason. Second, on some aspects of our overhead expenses, namely traveling and legal, we have seen a huge increase in cost, and that's across the board. So that's something which I would say we were caught completely unaware. So to give you a perspective, our traveling expenses have nearly gone up by 35% in the current year. And even if you compare to the pre-COVID year, they are much higher than that. And that's the true, reality of that entire segment. And we are redoing those numbers in the current year. Similarly, on legal expenses, given that, we had a few of our cases going on at advanced stage and we won a few of them. All of them had some impact, but otherwise it was business as normal. We are confident of being in that 8 to 9% range of EBITDA getting into on an annualized basis even next year. Our focus is a lot more on PBT rather than EBITDA, because for us our leverage ratios are much lower, and that's how we want to continue doing that. So our target is going to be that 4.5 to 5% PBT more than any other number getting into the future.
So the line for the participant dropped. We move on to the next participant. The next question is from the line of Tina Vermani from Kotak. Please go ahead.
Hi, sir. My question is again on the margin side, just to build upon what you have earlier mentioned. You mentioned that you are investing in building capabilities across different segments to increase the exposure going forward in these segments. Now, where is that reflected? So I'm just trying to understand how will margins behave in the next 1-2 years on account of these incremental investments, and how will that be going forward also? So is it reflected in higher other expenses, or is it reflected in higher employee cost, or like higher travel expenses? So the point is, if legacy projects are over, raw material cost is down, your gross margins will start improving. But then what incremental investments will happen in employee costs and other expenses which will drive the margin going forward, maybe in the single digit in the next 1-2 years, and then how will it move to double digits?
So Tina, a good question from a larger strategy perspective. Over the last 3 years, we've already built a lot of businesses. We've been building businesses continue, but within the sectors where we exist. So we've not gone and diversified into something which we do not understand. And that's something as a core we've stopped doing for the last 7 to 8 years. Within the businesses, what all we have done in the last 3 years, we've gone on civil international in a big way. We've got 3 large projects, Ghana, Ethiopia, and Maldives, the entire thing. Maldives, we have 3 projects right now. While some of them are reasonably good in margins, but a few of them are projects where we just went in to make sure that we build our pre-qualifications around that. As far as the profitability is concerned, and I just want to reiterate that at a PBT level, we've been targeting 4.5% to 5%, even pre-COVID, even during when we were double digit. The difference is the way we have leveraged our balance sheet. The difference is the way we have utilized the cash flows which came from a lot of our assets which we divested. So at a PBT level, even during the best times, if you go back, last 7-8 years, you'll see we were at that core 4.5, 5, rarely above that. Okay, and that's where we have come back. At the EBITDA level, it's a leverage which is so low on our balance sheet, which is impacting EBITDA from an outside perspective, where you start looking at 8 to 9% and not higher. It is that efficiency in managing working capital below 100 days is something which we are targeted, and we are below that, and we further go below from there. So it's important for everyone to understand that we are different in terms of having a balance sheet strength on debt, our ability to manage working capital, and our huge growth visibility. So we're not reducing margins. Our margins will continue to be in the range of 4.5 to 5%. Which would be one of the best in the industry, in the EPC industry sector, without compromising on debt, without compromising on working capital, and growing at 30% for the current year, and similar number is not, I'm sure all of you know the vision of 2025. 25,000 crore by 2025 is a vision which means a high double-digit growth even for next year. So our focus is a lot more on roads. So if you go back to our numbers of roads, we were at 12% levels 5 years ago. We have come to 16 to 18%. Our target is to take it to 18 to 20% in the current year and beyond 20% next year. So the entire focus is profit continues, profitable growth continues. So just so that we're clear on that. To answer your question on where are we investing, I think SKT mentioned earlier some segments like airports, data centers, and civil international, including civil oil and gas might be sectors that we might be average in terms of margins, not very, very bad, but not as good as, let's say, the existing business of transmission, B&F and water. But on an overall basis, we still believe that 4.5 to 5 is easily achievable as far as the current order book and the current year is concerned.
So you mean to say that even though there may be incremental investments in these areas, you will have savings on the interest cost, and that will drive your PBT margins of around 4.5 to 5%.
Exactly. And that's been our best always. Even when we were a double digit, if you go back and historically see our results, you see while we were double digit, but interest cost was much higher, depreciation was very different, and that's how it was, So we are improving profitability. Our focus is only profitable growth, not top line growth.
So will your debt not increase, sir, because you are going to grow at a very high pace, which had not happened earlier in past, because order inflows have been very good for the company. So technically, and even your target also for the growth is in the range of 25-30%. So will it not result in continued high debt levels for the company in terms of commitment required for working capital and all those things?
So Tina, definitely debt will increase compared to the current levels, because in our growth, we cannot grow without debt, because we are in a working capital intense business. Important is to see that can we keep our working capital levels below 100 days. Right? We have targeted an interest cost at lower than 2% of our sales, which is what even in the increased interest cost scenario, that's our target. So while debt would go up, right, but from a ROCE perspective and profitability perspective, it would still be better than what we had in the past.
Okay.
So the proportionate increase in debt is not going to be similar to the increase in revenue.
Got it. And the working capital
So just to add to this, our divestment of non-core assets also continues, right? So we earlier said that Indore, we should see cash flows coming into the current year. We're also focusing on a road asset where we are planning to sign a non-binding in the current quarter. So with all of that also, at least we are pretty confident that our ROCE numbers should only improve going forward.
Okay. And lastly, on the water business, where your size is also increasing, how is the payment cycle on the water business?
Sorry, can you repeat the question?
On water business, sir, since the order book and other inflows have been fairly good, how is the payment cycle in terms of receivables in water business?
So it is a good news sector. Here our working capital cycle days are less than 50. But at the same time, since we are spread over 13, 14 states, depending on the political and the financial condition of the states, we have to keep dabbling with the cash flows and moderating the business growth. Right. So this is the real condition on the ground, because some of the states suddenly you find that funds have dried up. We have to wait for a couple of months. But only thing is that most of these projects are supported by the multilateral funded agencies, either the World Bank or the ADB. So there is a certainty on that aspect.
Got it, sir. Thank you. That's it from my side.
Thank you. Next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, what was the reason for lower execution in T&D on the international side?
So Akshay, a lot of our international T&D order book had a long gestation, and primarily one large order which was in Chile, where there's a 12 to 18 months on design and environment, which is the client's responsibility. So from a perspective of where we started the current year, order book had a lot of orders which were long gestation, and a lot of orders moved into issues on a geopolitical front, whether it was Ukraine, Myanmar, Afghanistan, which is now out of our order book completely. We've removed that from our order book. So given all of that, we were just making sure that we delivered on all our commitments of the past, which is all done, and parallelly build an order book which is healthy margin. So, there was slight reduction in what we projected at a division level, but the good part is that the visibility now looks very good. It was a mix of those two, three things: gestation on some projects and some geopolitical issues in some countries.
Okay. So on the guidance front, in the earlier presentations, we didn't used to mention the word standalone, and now we have come up with this standalone thing. So I just wanted to know what all comes in standalone. So you did clarify that GMC is a part of standalone. So Lindsay Montage, Pastel would be in the console, right?
Yeah. So thank you for highlighting this. I had also not seen it on a lighter note. Yeah. So Lindsay Montage and Pastel would be more than console. Standalone is our entire KPTL and erstwhile GMC business. Console would include the road assets, Shimam Logistics, Lindsay Montage, Pastel, and the indoor real estate.
Okay. So
and there on a console basis also we're looking at a growth of 25% plus. Although our internal target is higher than that, but for the external world it is on a console basis also we're looking at a growth of minimum 25% plus.
Okay. And PBT margin?
PBT margin same in the range of 4.5% to 5%. So we're seeing a huge turnaround in Brazil also, where we have suffered a huge loss in the last 2 years. And we expect Brazil to be positive on a PBT level, not only at the EBITDA level in the current year. And that will also help us from a margin turnaround perspective. So our only challenge now as far as the console margin is on Shubham Logistics, where we're still not seeing our warehouse utilizations improving. We're seeing good traction on road assets. We are seeing good traction on Lindsay Montage. We are seeing good traction on Fast. We are seeing cash flows coming in on indoor. Our only challenge continues to be Shubham Logistics, where we believe we might still have a year of challenges because warehouses are not utilized even to the break-even level. It's good at a EBITDA level, but PBT level we have challenges on Shubham Logistics.
And so this Vision 2025, which is mentioned, it is CY 2025 or FY 2025?
It is FY 2025. Yes, 2025 next year, 24-25. FY 24-25.
Yeah. Okay. So lastly, long-term borrowings have decreased and short-term borrowings have increased. So what is the reason for that?
No, I don't think there will be any specific reason except for maybe the interest cost as well as availability of long-term loans at a given point of time. It's not strategic as much as it's about opportunity of having lower interest cost, one. Second, it's also driven by our visibility on cash flows for the near future. So if you see Q4, our cash flows were very, very good, right? And if you see your visibility of cash flows to be very good in the near future, you typically love to keep short term. But getting into the next year, we should be again taking some long-term loans once interest rates stabilize at a particular level.
Okay. And our other intangible assets have decreased and asset held for sale have increased. So what was the reason for that?
So I think other intangible assets primarily have some write-offs coming on a few of our investments. So Shubham Logistics was one of them, as well as the losses on Brazil. As far as asset held for sale, I think we have classified one of the road assets as asset held for sale because we believe that we will be getting a non-binding offer very, very soon. It might not even go beyond this month. And we already are in active touch with it. Yesterday, we have got in principle approval from the senior management also. So that's why it's kept for asset held for sale. And I'm pretty confident of finding that in this month itself, not even June.
And there is also a liability associated with asset held for sale. So net off, there has been no movement. So what is that liability?
It would be the loans on that that portfolio. It's a similar thing. But I'll have to see those details and come back to you.
Okay. Thanks a lot, and I'll get back in the queue.
Thank you. Next question is from the line of Bharat Seth from Quest Investment Advisors. Please go ahead.
Hi, good morning, Manishji and Tripathi and congratulations on good set of numbers.
Good morning, Bharat.
Good morning, Bharat.
Sir, my first question is, since last 1 or 2 years, we have been expanding our geographical as well as within that geography vertical also we are expanding. New vertical we are building. So in order, in medium term perspective, what are exactly that each geography has some kind of, geopolitical or surprises or, so what is our risk management capability that we are building from medium term perspective? So this kind of a surprise should not really affect us. And
So, Bharat, I think a very important question for us. This entire last 4 years, whether it started from COVID, whether it started from the war, a lot of learnings for us. I think, hello?
Yeah.
I think the good part is historically we've been following this consistent policy of taking ECGC across all our projects. And that's why even if when you look at Afghanistan, more than 80% of our dues have come from ECGC. So we will continue to make sure that at least on a global front, we will take ECGC on all projects. Where at least in those countries where you believe that even there's a 1% risk. So that's one thing which we are very focused on. Second, we have slowly over the last 3 years, if you look at our portfolio, we moved to a lot of developed countries, right? So look at Chile, look at Australia, look at our expansion in LATAM, look at what we are doing in few of our geographies in neighboring countries which are funded by EXIM. So our focus is, compared to what we were 4 years ago, our focus is to move to a lot more developed economies, which one has limited competition, where delivery is the key requirement. And while you can get in there as a small player and then eventually grow to be a large player. So that's been our second focus. Third, on a risk management perspective, we further strengthen our risk management committee, both at a business unit level, at a SBG level, which is strategic business group level, as well as at the company level, where we look at a lot of this very, very closely. I would be happy to sometimes discuss with you about how our risk profile in the last 3 years. 3 years ago, majority of our exposure were in countries which were more in the category of B and C. But today, more than 50% of our exposure are in countries which are more in the category of A and B from a ECGC rating perspective.
Okay.
So that also helps us. So gradually, we've obviously learned from the last 3-4 years, and we're making sure that as much as we can, we cover through prudent risk management policies. The one more aspect is our breakup of fixed and variable order book. So if you look at today, our variable order book is closer to 65% of our total order book size. Actually more than 65%. I think someone, Ram, has corrected me for that. But that's what is gradually growing. So as long as we get into that variable order book a lot more, at least we do not lose on a lot of surprises. We might not gain on surprises because that's not our core business, but we do not lose on surprises. So it's been a mix of new countries, variable to fixed, strengthening our risk management across the geographies and continue taking insurance for majority of the countries, if not all.
Okay, great. And so that is largely say on the external side that we are working, but internal like execution. In this developed country, timeliness is very important. So execution perspective, how we are building those capabilities so that we internally should not default over there.
So, Bharat, important for, and you've been associated for the company for long to understand that we're going international only in businesses which have grown in India for at least 5 to 7 years.
Correct.
So if you look at our approach, it's been that, we were doing only transmission international till 3 years ago.
Okay.
Last 5 to 7 years, we built huge capabilities on buildings and factories and civil. We went international on that just 1 year ago. Oil and gas, we built huge capabilities in India over the last 10 years. We're going international now. So we are also cautious on the fact that not to go international unless we have a strong team on all aspects, whether it is tendering, whether it is execution, whether it is project management, and whether it is the commercial side of it. So we are not going international any business which is new in nature, right? So if you look at our international growth, it's been only in sectors where we have a strong team in India, on the basis of which we build a strong international team, on the basis of which we have built over a period of time and done one order, delivered, and then grown it further. One. Second, we've also not grown very fast on new businesses. So if you see, even in transmission international, if you go back to history 10 years ago, you would take 3-4 orders, deliver, and then go to the next 3 orders. So that's what we have done here also. We've taken 5-6 orders, we're building, ramping up the team, and then we will take further larger orders in size and scale. We're in no hurry for top line growth. Let me assure you, we are in no hurry for top line growth. For us, it is profit which makes a lot more important than revenue.
That. And last bookkeeping, what are our capex for 2 years, 24 and 25?
So for the current year, we budgeted for capex around 275 crores based on the current order book. If you win any large orders in urban infra or international oil and gas, we might revise this CapEx upward. But otherwise, we believe on an annualized basis, we should be okay with 275 to 300 crores for this year and next year.
Okay. All the best, sir. Thank you very much.
Thank you very much.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Ashwani Sharma from ICICI Securities. Please go ahead.
Yeah, good morning. Thanks for the opportunity. So my first question is on the debt. So you did alluded on the fact that there will be increase in the debt going ahead as the order book has gone up. But in case if you can just put some numbers, how do you see debt shaping up in FY24 and 25? And related question is this that you did mention on the interest cost saving because of the merger. Here also, if you can put some number, what kind of savings do you see because of the merger?
Sure. So on a standalone basis, our net debt levels are around 1,700 crores while we speak on 31st March. We believe that we should be at levels of not beyond 22 to 2,300 crores by the year end, even with a 30% growth. So that's on a net debt basis. As far as interest cost is concerned, even in the rising interest cost scenario, we're still targeting our interest cost as a percentage to be sales to be below 2%. Right? And that's where we have inbuilt all the savings coming from the JMC merger, all the savings coming from our effective working capital management, and also increased advances which we are not taking at some point of time given the huge difference in the interest rate on advances versus the banking interest rates. So with the combination of all of this, I think, if you look at the console numbers where they're going to be at 20,000 plus crores, and standalone numbers which would be at a number of anywhere between 18 to 19,000 crores, we believe that our interest cost should be in the range of, at a standalone level, in the range of 350 odd crores, if not slightly lower than that.
Thank you. So do you see any infusion in road assets during the year or Shubham Logistics just to fund the losses?
So can you repeat the question?
Ashwani, sorry to interrupt you, but your voice is not coming very clearly. It's coming a little muffled. Can I request you to speak through the handset?
Yeah, sorry for that. So any infusion required in road assets and Shubham Logistics during the year?
So road assets, if you know, these assets are almost 8 to 9 years in their life cycle time, and they will be requiring the O&M, the major maintenance. Right? So we will be requiring to infuse about 50 to 60 crores towards that account. If you look at two SPVs, even at the PBT level, they are break even. One SPV will still require the fund support. So that is the situation currently. So we have to infuse the money, but major amount of that will go towards the major maintenance, which is due now on the project. And
yeah.
On Shubham Logistics, we do not see immediate infusion of capital required, but we will revisit that at the end of Q2. If we do not see improvement in traction, just to repay some of the external loans, at Shubham Logistics, the external loan number is around 170 crores as of 31st March. We might be revisiting this number at the end of Q2.
Okay. Just a bookkeeping question, sir. On the international subsidiaries, both Fossil and Linjemontage, if you can just provide the bottom line numbers or PBT numbers.
So as far as on an annualized basis, Linjemontage had a profit of approximately 44 crores at the KPTL Sweden level. And as far as Fossil is concerned, we had a loss of, last quarter I remember, around 56 crores. Yeah, Kalpataru Brazil is a loss of 56 crores and KPTL Sweden has a profit of 44 crores on an annualized basis. The revenue number was 1,002 crores and with a profit at 44 crores. As far as Brazil is concerned, revenue of 439 crores with a loss of 56 crores.
Yeah. So last question from my side. The NWC number, which is 100, is what you're saying. Is it possible to give us the breakup between T&D business and the other civil and BRM business?
I might not have that breakup immediately. It might help if you can just connect with the team. any of them, Vishesh, Kunal, and they'll be happy to provide you those details.
Sure, sir. Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Amin from State Bank of India. Please go ahead. Amin, can you hear us? Hello, Amin, can you hear us? Due to no response, we move on to the next participant. The next question is from the line of Parikshit Kandapal from HDFC. Please go ahead.
Sorry, sir, I got dropped out earlier. My question is on the promoter shareholding. So after the merger, we have seen in this quarter the promoter shareholding has come down to 47% because of the merger. And given the bad press which we recently had on the group, do you think now when we have come below the psychological level of 50%, can promoter offload some more shares in the market and this holding go towards more 40%, or will it will go above 50%? So what's your view there?
So Parikshit, we do not have any specific view on this question. We have not had any discussion with promoters on this aspect. Our only discussion with them was on the pledge component, and where they have told us that pledge will continuously reduce only. They have a plan going forward, but you'll see the pledge reducing going on quarter. As far as the promoter holding is concerned, we have not had any specific discussion with the promoter on this aspect.
Okay. My second question on the road monetization. So you said that one asset will get monetized. So likely, what could be the potential, the deal value, or you can also give some sense on what is the total equity investment in that asset, whether we'll be able to recover a large part of it, or there could be potentially a write-off. So if you could give some sense on that.
Parikshit, we might not be able to share the deal contours at this stage because we are at the signing stage of the non-binding offer. We can only tell you that we're getting much more than the equity what we have invested.
Okay. And how was the total equity investment in that asset?
No, I'll not be able to give you those contours right now, as I said earlier, but just keep patient for the next 2, 3, 4 weeks, and we might be able to share those details once we sign the non-binding offer.
Okay, sir. Thank you, and wish you all the best.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. On behalf of Kalpataru Power Transmission Limited and Emkay Global Financial Services, we thank all the participants. You may now disconnect your lines. Thank you.